Rohr here with an early morning global view once again. The second global view in a row because there was a lot of movement yesterday in all of the asset classes. It's currently 6:45 a.m. U.S. Central Time, and the first thing we want to stress is that the major macro influences should have been better for equities on the back of that much better than expected U.S. GDP on Wednesday. Looking at how this actually is playing out in the short-term view of the S&P 500, the market is actually down a whopping $12 this morning, down to the 1953 level. Now, this is interesting because, of course, it has already been down into levels like 1948 area before snapping back up, and we're still keying on 1950 to the trading low back on the 17th at 1949.30 to see if the market holds for a broader pattern that could see it fill out right back up into the mid to upper 1970s again. However, if it's much below 1950, and if it in fact is much below 55 at all in the first hour today, it is going to be signaling some downside acceleration out of the overall downward trend. And some people might ask, well, what would knock the market after a plus 4% annualized GDP in the U.S. yesterday? What would knock the market that hard? And the answer is the same reasons we've been skeptical of equities for a while. Even if yesterday's strong GDP weighed on the government bond markets as well, the equities have geopolitical background in the Ukrainian in sanctions against Russia, and that's something that just is most likely to backlash into an already weak European economy. And you now have the Argentinian renewed debt default for the second time in 12 years. Argentina has defaulted due to some holdout bondholders of theirs that did not agree to settle and won their case in court all the way up to the U.S. Supreme Court. And therefore we have this movement back toward a much more disruptive environment, what I called politico-economic entropy. There is a sense of things going a bit more chaotic, and the equities don't like that. Now, we have to watch this very closely today because, as you'll see from yesterday, the short-term projections on the hourly MACD and the 30-minute MACD got very close to leaking out through their lower runaway band when the market was under pressure below 1960 yesterday. I think we have to see whether it starts dropping below 1950 today, even if the next incremental support is in the 38 to 33 range. It's going to be important to see whether or not it starts remaining below 50. That could bring that additional $12 to $17 break. And with that, we move over to the intermediate term picture of the S&P 500, and that is just reinforcing everything we discussed about the short-term picture. And you will notice that on the left hand, last week the 41-week average was about 1852. This week it has moved up to the 1858 level, and that's important because for the purpose of our weekly oscillator, that means it is moving up with this topping line once again. So 1990 topping line, 135 plus that 1858 would be 1893 on the oscillator. So that remains the higher resistance. But more importantly, you can see the overrun downward reversal going all the way back to late June. That was from the 1953 area. We set up a tolerance for that around 1950. And with some minor slippage, that's where the market is held. So we're going to be in another test of that mid to low 50s this morning if the market opens up in line with what we've been seeing so far in the overnight trade. And you can see why we also are still keen to look at 1938, which was previous congestion, and held support into the 38 to 35 level that we now extend to 33 based upon the previous congestion in the area and the previous gap going all the way back to the early June period.